right now, if you look at the curve, it's still incredibly backwardated. There's a lot of structural reasons for it, but it also, you can imagine a few things play out differently. In 5 years, you could wake up and have lower oil prices. You can also make the case it's going to be higher. So I don't know, it's the $1 million question in our business, but the strength is, can you underwrite to something that you think is durable? And I think even if you can hedge the strip on PDP acquisitions, which is what we're focused on, really having anchored around kind of a more reasonable long-term oil price, I think is important, because if you take oil prices up to $90 long term, you're taking a lot of risk there on these deals. I think that risk profile has allowed people to say, hey, I'm going to use this tool where I can buy an oil and gas asset, PDP-heavy, and put 75, 80% leverage on it, put in 20%, it's like a real estate deal. And, as long as I can, maintain the OPEX profile, maintain the production profile, and, I've hedged my commodity price risk, this is actually like a tool that I can use to put a lot less equity in and, still get my return on what we call the residual equity. And that has changed the game. And so because of that, you've seen valuations push upwards among PDP assets. Look, 3 or 4 months ago, we saw virtually no oil deals coming to market when we taped this the first time. And today, I'd say almost all the deal flow that we're seeing is, I'd say 75, 80%. All these, oil deals that had kind of missed the window back when prices were high and, what was that, 21, 22, they'd kind of come off the market and people said, hey, we're going to hold it, wait for a better day. Well, the better day is here.
Michael, thanks so much for taking the time. Good to sit down in Denver. We brought the weather over from the UK.
Yeah, I know. This is atypical. Normally it's sunny.
Yeah, I literally packed one jumper, like one hoodie, thinking it's May and we're going to everyone's been saying how mild the winter's been. And I'm like, look at the forecast and it's like storm warnings for the 2 days I'm in town. So
it's supposed to snow tomorrow. We couldn't get snow all season and finally getting some.
No, anyhow, but really good to sit down. Appreciate the time. Yeah. And I guess just for the benefit of everyone watching, obviously I think you probably need little introduction to our energy audience and sort of energy circles more broadly, and many will be familiar with Diversified specifically, but for the more generalist audience that we're appealing to, just give me a bit of background on yourself, who you are, your journey, sort of how you got into the energy business, and the journey up until joining Diversified.
That's great. Well, so right after MBA, went to the University of Texas, got my MBA, hook 'em horns. I joined Morgan Stanley. I actually joined a boutique, Scotia Watchers, for a year, and then went to Morgan Stanley. Spent 4 or 5 years there in the energy investment banking group. I got lured out by one of my clients, Blackstone, to go be VP Finance and Treasurer for Vine Oil and Gas. And then I was CFO for Chisholm Oil and Gas. And then I had a really neat opportunity. I started my own plugging business with Elliott Management called Greenfield Environmental Solutions. That brought me to Denver, actually. And it was through Diversified that I actually met Rusty Hudson and Brad Gray at Diversified. They'd actually purchased all of our plugging targets in Appalachia and built what is now Next Level. So I got to know them through the plugging business, actually. And when we sold Greenfield, they said, hey, I realize you're actually an upstream M&A guy. Would you like to come join us and help us run business development? And so I've been here now for 2.5 years, I guess, 2.5 years coming on 3. And it's been a great ride. We've done $2.5 billion worth of transactions across probably 10 deals, and we've done some really great things and really fortified our balance sheet and improved our cash flows, and it's just a really high quality business run by really great people. So that's how I got to Diversified.
Awesome. No, that's really helpful. Thank you. And I think I've got to know the company pretty well over the last couple of years, and I'm familiar with the strategy and sort of the position you continue to build. For the benefit of the audience, can you just outline sort of Diversified Energy's model today and how scale, asset life extension, and free cash flow durability shape how you think about investing?
Yeah, absolutely. So every deal that we do here, we're hyper focused. First of all, on the cash flows of the business. We pay a robust dividend. It's probably 7.5%-8% today. Depending on where the share price is. That dividend has been kind of the lifeblood of our business. We originally went to or our CEO, Rusty, went to London, raised $1 billion of equity on the London markets, which are very fixed income oriented. And today, even though we now have our primary listing in the U.S., we continue to focus on making sure that we pay a very stable dividend. So everything that we do is focused on cash flow durability and the quality of cash flows that we have. And we focus on maintaining, growing through PDP. We're adding in little elements of reinvestment. And so everything that we do, though, focuses on distributable cash flow and making sure that we have adequate dividend coverage to continue paying that dividend. And then there's also, great, opportunities for share price growth through some of the M&A that we do, some of the organic reinvestment, and then, I think potentially a re-rate of the stock at some point.
I know that's super helpful. Thanks. And I first connected with Rusty probably 5-6 years ago, and sort of predominantly through a lot of the activity on the London markets. You just alluded there to the fact that the primary listing is now in the US.
That's right.
Are you able to speak about some of the reasoning behind why you sort of made that move and behind that transition?
For sure. Look, there have been a lot of fund outflow. I think, as I said a second ago, the UK market's very fixed income driven. And so I think higher interest rates, there's a lot of things that you could go into, and ESG in Europe and whatnot, but particularly at higher interest rates, I think, the UK has seen a lot of fund outflows. And, the US has a much more dynamic, much larger market, much more dynamic, much more used to investing in energy stocks. And so, the company made the decision, I guess it was December of 23, we stood up a secondary listing on the New York Stock Exchange. We saw a lot of our shares immediately move over. And so 2.5 years later, we were able to actually move the primary listing. So it was exciting. We just got to go up and ring the bell to commemorate, moving our primary listing to the NYSE. And it was a great experience. And we see a lot more investor momentum being in the US than where the UK is right now.
Yeah, no, it's something that's, I think, interesting to Amy, myself, and the broader team, because a lot of the reason behind having launched Pragma, a lot of our activity is US-centric and US-based.
Sure.
But
you see it too.
Yeah, exactly. And hence we're always over here. But right. I think a lot of the motivation behind wanting to launch the brand was that just oil and gas and the industry had fallen out of favor in Europe and the UK specifically. And that's an ongoing battle. I think people are more pragmatic about it, but it's interesting to get those perspectives on, I guess, access to liquidity and to capital in the US markets versus European markets. So thank you for that. But I think we sat down at the beginning of this year, and sort of a lot of the comments that we sort of spoke about then, maybe we've deemed to be less relevant today, in the fact that a couple of weeks later, significant geopolitical events sort of took place, which have changed quite dramatically the nature of the commodity markets, the oil and gas markets, and just sort of deal activity and sort of how buyers and sellers are interacting with each other. So before we go into that, obviously, as I said, since we last spoke, geopolitics has moved from a background risk to front and center driver of commodity prices, particularly obviously following the conflict in the Middle East and Iran. How much of the current strength in oil and gas prices do you view as structural versus as a temporal geopolitical premium?
Yeah, it's that is $1 million question when you're underwriting oil deals right now. I mean, when you look at where I think some of these oil deals are going to transact, if you I think the world used to, call it 6 months ago, was in a $65 long-term oil world. I think we saw Trump as, sort of trying to balance the tariffs on the back of the oil and gas business. And, now you kind of look at the world and you go, hey, Trump doesn't actually control the market. We don't, we're not going to necessarily be in a sub $65 world. The risk premium is being realized. And, what is that? Right now, I think it's hard to say. If you look at deals on $75 long-term oil, I think you can feel really good about getting something. But, we've seen this oscillate, every few years as to kind of where the oil and gas sector benchmarks deals. I'd say right now, if you look at the curve, it's still incredibly backwardated. There's a lot of structural reasons for it. But, also, you can imagine a few things play out differently. In 5 years, you could wake up and have lower oil prices. You can also make the case it's going to be higher. So I don't know. It's the $1 million question in our business. But, the strength is, can you underwrite to something that you think is durable? And I think even if you can hedge the strip on PDP acquisitions, which is what we're focused on, really having, anchored around kind of a more reasonable long-term oil price, I think, is important, because if you take oil prices up to $90 long term, you're taking a lot of risk there on these deals.
Sure. And I want to get into some of the sort of OPEC dynamics and supply uncertainty as well. Obviously, we've got a lot of shifting dynamics within OPEC. We've seen sort of the UAE's positioning most recently over the last week or two. There's therefore more uncertainty around sort of coordinated supply. How should investors think about the durability of supply discipline? And what does that mean moving forward for oil versus gas pricing, and how groups should look at, or investors should look at, commodity pricing more broadly?
I sometimes, when we were in New York last for the advisory board, we sat around with a great panel of people, and I remember there were lots of kind of macro economists and equity research guys who I was blown away with their kind of perspective on, kind of supply and demand. I humbly would say I'm more of a tactical M&A guy, and I have probably a harder time opining with any authority on that. I do think, you are seeing a response here in the U.S. where people are beginning to add more rigs. It's not the world that we were in, 3-4 months ago, where people were talking about dropping rigs. And so I do think you're going to see that supply response. Is that enough here in the U.S. to help make up? I don't think so. And I think, everything that you read is that it's going to take longer, not shorter, to, even if the Strait reopens, it's going to take a longer time to kind of really, backfill all the barrels. And so I think we're going to be structurally short oil for a while. And so I think that can give a lot of people confidence when you're underwriting, oil and gas deals right now, at least in the near term.
Yeah, and I think looking at deals specifically, obviously when we spoke at the beginning of the year, the narrative was more gas-heavy deal flow, partly driven by softer oil prices. It seemed, I think, a lot of feedback we were getting from different investors we were speaking to is it's a great buying window for oil assets, with it obviously being a lower price environment. That now seems to have shifted meaningfully.
That's right.
What are you seeing today in upstream M&A in terms of oil versus gas deal flow, and what's driving that change? Yeah.
For your audience benefit, it's probably worth letting him in on the joke that we taped this and it was incredibly gas centric at the time. And looking back on it, I said, hey, if I have another opportunity to talk about this again, it's changed so much. And look, 3 or 4 months ago, we saw virtually no oil deals coming to market when we taped this the first time. And today, I'd say almost all the deal flow that we're seeing is, I'd say 75, 80%, all these, oil deals that had kind of missed the window back when prices were high and, what was that, 21, 22, they'd kind of come off the market and people said, hey, we're going to hold it, wait for a better day. Well, the better day is here. And every sponsor is bringing their, oil-weighted, businesses to market right now. And so I'm getting, probably a teaser a week on, a multi-billion-dollar, transaction that's oil-weighted. If you had said, 3-4 months ago, it was all gas-weighted deals, and that's where you saw it. And so we are still seeing the gas deals come. Appalachia has been a very hot basin. You've seen HG get acquired by Antero. You saw the Antero Utica assets get acquired by Infinity and Northern. And so there's been a lot of gas flow in Appalachia. You've seen a lot of deal flow in gas deal flow in the Gulf Coast with a lot of particularly these Asian buyers that are coming in. But we are seeing a lot of oil deal flow now. It's quite something to watch as it comes.
Okay. And as we look at sort of current valuations and how you're thinking about the current valuations across both oil and gas, are we seeing a justified repricing of these assets, or is there a risk that assets are being marked up on short-term commodity strengths, or is that something that's here to stay?
I think, again, we're mostly focused on PDP-heavy acquisitions. We are buying undeveloped acreage, and we are beginning to reinvest. We did, when we bought the Maverick assets, it came with a great JV with Mewburn in the Cherokee play. And so we have become more accustomed to it. I just emphasize that because the PDP-heavy transactions, you can hedge. And so, when you go into these transactions, and you're worried about prices moving, particularly because we're already set up, we can actually begin hedging on our balance sheet. Right when we know that we're getting, sign an LOI, we can begin hedging on our balance sheet to kind of protect the cash flows of that deal. So that's an advantage that we have in going out into the PDP market. I think for buyers that are more focused on the undeveloped, if you saw something with a lot of undeveloped inventory, I think that's where you have to think a lot harder around, how do you underwrite that? And, what I can say we do is we kind of look at it on multiple price decks and make sure that we feel good at, $65 oil, $75 oil, flat as well as strip. And, and if you're kind of looking at it both ways and you run your sensitivities, you can kind of get comfortable, with what you're willing to pay at those prices. And so I'd say, you kind of, if you take out the strip, 3 years and hold it flat, you're probably going to end up paying a lot bigger number. You're going to take a lot of price risk in what you're paying for those undeveloped locations.
Sure. No, that's super interesting. Thank you. And I think, again, just drawing on a couple of conversations we've been having over the past month, 2 months, I think this theme that has been consistent for years in the upstream oil and gas industry is the industry has experienced this outflow of capital, this dearth of capital, and of course now with all the supply and demand dynamics we're seeing playing out, whether it's anticipated power demand growth from AI and data centers. Now, obviously, we've got the geopolitical events that are layered on top of that, which are, and obviously the supply that's been taken off the market. I think it's now brought the industry back to sort of top of mind for a lot of folks and placed the importance of that supply picture and the fact that it's not one or the other. We're going to need all forms of energy sort of at the front of people's minds. I think but yet we still see this lack of capital relative to the amount of capital the sector requires. Despite that, we're obviously in a very competitive deal environment. And so I guess the question to you would be, in today's environment, is it a buyer's environment? Is it a seller's environment? And where are you seeing the most competitive tension? And where is capital still more selective?
Yeah, absolutely. Look, I think just maybe taking the end, your second question first. When you look at today's environment, is it a buyer's market or a seller's market? I look on the gas side. When you see the tailwinds on the gas side, I think you can make the case that you'll be able to look back and say, this was a buyer's market. Even though gas prices are higher now than they were a couple of years ago, between AI, data centers, LNG exports, kind of the tier one inventory beginning to run, short in a lot of these, kind of premier gas plays, you start to look at it and you go, this still could be a phenomenal time to buy gas assets. I do actually, believe that this is you'll look back in a few years and say, man, I wish I was buying gas in 2026. On the oil side, obviously we've had such a run up. I'd say, right now it's definitely a seller's market on the oil side. And I think that's why you see so many people rushing. I think as long as it's a PDP-heavy asset though, and you can really hedge those cash flows, I think you can, find value still. And so that's where, I think, I would just be nervous, buying a lot of undeveloped locations at kind of current strip. That would make me nervous. But I'd say on the gas side, if you kind of you buy today, I think you're going to be rewarded for it in a few years. Okay,
interesting. And obviously we see a difference in the behavior of public operators versus private operators, and maybe the types of opportunities that they go after. A lot of publicly E&Ps have largely maintained capital discipline, while private capital, by contrast, often drives marginal supply and transaction activity. How is the current macro backdrop influencing behavior across public versus private operators? And does that create more opportunity or more risk in the M&A markets?
Yeah, look, I think what you're seeing on the private side is twofold. One, people adding incremental rigs. They're going and drilling their locations that didn't really work at $65 oil, and they are adding rigs and they are adding frac crews and they are turning those wells online. They are ramping production and they are doing exactly what they should. And that's, and then for those that aren't doing that, they're bringing their assets to market. And so really, I think the privates are behaving the way you would expect them to. They're private equity backed or they're owned by family offices, and they're saying, how do I make money in this environment? You're either exiting or you're drilling. And that's what the oil-weighted kind of privates are doing. On the gas side, the privates are also doing the same thing. I mean, you've got, relative to the last couple of years, stronger gas prices, and you're really, you can bring a well on, you can hedge into the curve, and feel really good about, what you're doing. You're seeing the tier 2 acreage. Tier 2 acreage is becoming the new tier 1. And then on the public side, though, you're still seeing the discipline of maintaining a return of capital and discipline around balance sheets. And so I'd say as a public company right now, again, we're a little different because we maintain what I'd say very durable cash flows, as we talked about earlier. We're very focused on the dividend, but we are also looking at ways that we can add more reinvestment, and we can talk about that in a little bit.
Yeah.
So but I'd say by and large, you're still seeing more discipline among the publics, and the privates are taking advantage of the opportunity right now.
Yeah, no, absolutely. And I guess I've asked you a lot about it, and I'll ask one more question before we move on to a few other themes. Obviously, you've spoken about sort of how it's still an attractive time to be a buyer of gas assets, and if in 5 years' time you're looking back and saying, "Hey, in 2026, I wish I'd been out in the market buying gas assets." Obviously, gas has the long-term structural demand story, LNG, power, AI, while oil's benefiting more directly from geopolitical supply risk. In today's market, what's more attractive? How are you thinking about relative attractiveness today between oil-weighted assets, gas-weighted assets? If you have to go for one or the other, which are you leaning into?
Well, I'll split the difference, and so we're working on a transaction right now that's third. It's kind of the typical third, NGLs, gas and oil, and I think that's kind of an appropriate way. But I do like right now buying things that are gas-weighted, and so I think some of the things that we hopefully announce soon are going to be gas weighted. I think those are some of the most exciting right now. But again, I would say for oil weighted assets that are PDP heavy, we'll hedge 80-90% of that and feel pretty good about the as long as we benchmark that to an appropriate kind of long-term oil price. I think we'll feel pretty good about those valuations as well.
Okay, interesting. And I guess moving on, I want to talk specifically about asset-backed securitizations. ABS as a strategic tool. Obviously, Diversified in particular has been a real pioneer in applying ABS structures to upstream assets, one of the first movers. And obviously, it's been a very successful strategy for you over the past couple of years. Maybe just setting the scene, what makes long-life PDP assets particularly well-suited to securitization, and why has ABS become such a powerful financing tool in this market and in helping to open the door to a broader set of capital providers?
Yeah, look, there's a lot of people that you could bring on and probably talk more specifically about the ABS market in terms of, across multiple sectors. We use it a lot, and I can talk about it more in the context of, what we do at Diversified. But, this is a very large sector that, kind of pocket of capital out there that really invests in everything from aircraft leasing to infrastructure to real estate to oil and gas. And oil and gas is, I believe, a much smaller actual component of it. But historically speaking, the returns have been a little bit better in oil and gas, ABS investing than in other sectors. And so we've seen a lot of capital come here. My company, Diversified, long before I joined, they did the first oil and gas operated ABS. And then, we've done, 10 or 11 of them at this point, including all of our refinancings that we've done. And it's been a great tool where we are able to say, hey, we've got these really durable cash flows. We're going to put it in a non-recourse amortizing structure and hedge it out and make sure that we can provide that stability, that we want with our dividend. And it's been a great financing tool for acquisitions. It's allowed us to kind of move up a little bit higher in leverage, but not with the susceptibility of borrowing base redeterminations and the whims of the RBL market. It's a very permanent source of capital that really is kind of bolts onto our strategy really well with buying PDP heavy assets. And so I think what you've seen is a lot of people see what Diversified has done and then come in and kind of do a little bit of a copycat. There's a lot of privates that are doing it. I think there's maybe one other company that's public that went public recently that's got an ABS. But generally speaking, we blow any other publics out of the water in terms of the number of ABSs that we've done, and even among the privates, we've got a much more kind of storied history with the financial product. But you are seeing more people copy it and say, hey, we look at what Diversified's doing. how do we copy that and implement that ourselves? And so that has driven, I'd say, the valuations up on PDP assets. But when we look at it, a lot of the PD valuations that you see out there, they're not unjustified given the fact that these are low cost of capital. They are amortizing, non-recourse, so you're not putting your money in at risk of default. And so I think it's kind of a natural evolution that you see valuations move up as more of this capital's kind of come into the space.
Yeah, super interesting. And we're actually just starting to see, I guess, more appetite and interest around these ABS structures in the UK and Europe and around the North Sea as well. Okay. I'm not going to quiz you on that, don't worry. But we're actually doing, I think, a roundtable later this month for North Sea operators, as well as a dinner maybe next month in London, as that seems to be a tool that some of those players are trying to tap into, which is interesting because that market has typically sort of been dominated by RBLs and sort of high yield. And I guess the reason I say that is the next question I want to put to you is, how does ABS fundamentally, and again, I want to spell this out in black and white for more generalist groups looking at the industry that may not have allocated or invested in the space previously, how does ABS fundamentally change the risk-return profile for investors compared to traditional financing like RBL and high yield?
Absolutely. Look, I think the risk historically has been, if you pay too much for an asset and you put too much leverage on it, back in 2014, I remember when people were doing, RBLs plus big second liens and putting in a little bit of equity, you have the risk of default. And if you default and you trip covenants, then, you can lose your equity. What I think the ABS has changed is the calculus that your capital is not at risk in the same way. If the ABS, if the SPV that gets created with the set of cash flows doesn't perform to the underwriting, maybe your cash flows shut off for a little while. But you still kind of own the residual tail, and as long as it ultimately amortizes down within the the final maturity, your equity is still protected even if you're not getting cash flow on it. And so I think that risk profile has allowed people to say, hey, I'm going to use this tool where I can buy an oil and gas asset, PDP-heavy, and put 75, 80% leverage on it, put in 20%. It's like a real estate deal. And as long as I can maintain the OPEX profile, maintain the production profile, and I've hedged my commodity price risk, this is actually like a tool that I can use to put a lot less equity in, and still get my return on what we call the residual equity. And that has changed the game. And so because of that, you've seen valuations push upwards among PDP assets.
Awesome. No, that's really helpful. Thank you. And obviously, I know something we've spoken about previously, what we recorded back in January, was you obviously last year announced a partnership with Carlyle.
Yes.
Can you just spell that out, lay it out? What is that partnership, and what doors does that open for you moving forward?
Absolutely. So, in the press release when we announced that partnership, we said, hey, we're going to, partner with them. They're going to give us $2 billion of capital, both, within helping us place ABSs as well as co-investing alongside us in the residual equity of these SPVs that we would create. And that, partnership, the first deal that we did was Canvas Energy. We ended up, for a variety of reasons, buying 100% of the residual equity in that SPV that got created. But Carlyle did help us fund the ABS and provided committed financing for us to close that deal. We're looking at a lot of other deals with them right now where, they would take a really large chunk of the residual equity, could be 60%, 70%. We would invest, 30 or 40%. We would be a minority owner. It would sort of, because of that, it would get kind of, accounting treatment where it would sort of be off balance sheet, and we would get our residual cash flows off the SPV. And it allows us to really scale and look at very large deals. I mean, I would say even though the $2 billion number is out there, I don't think the Carlyle folks would, slap me on the wrist for saying it's really almost unlimited capital for residual equity in SPVs. And we've got a very robust pipeline. We're looking at deals that are, $1 billion, $2 billion, $3 billion of PDP value. And between the two of us, we look at it and go, we have all the resources we need to take these down. And this really secures Diversified's future. If you think about what we do is we reinvest and we buy, we did this with Oaktree. We did a partnership. We did a series of deals with them when our balance sheet was smaller, And then as it got bigger, we were able to come back in and buy out, the Oak Tree interests. We'll have the same thing now, but with multiple SPVs that we've done with Carlyle. And then over time, as the ABS is amortized down, the production declines, we'll be able to buy those back. And I mean, you can really, when you run the models, you can see kind of indefinite durability of our cash flows and our, ability to pay the dividend and also have, cash flow for reinvestment for growth. And so, it's really a very strategic partnership for us. And we work seamlessly with them, hand in hand every day. And we're really excited about some of the things that we're going to do here soon.
No, that's awesome. And obviously you alluded to the pipeline. I just want to sort of put a question to you about what that pipeline looks like moving forward. I think a lot of feedback we've received when looking at lower 48 and the basins across lower 48 is the fact that it's a maturing basin, declining assets, sort of the need to replenish, declining inventories, a lot of tier one assets being sort of swallowed up and sort of gathered up by the majors, and obviously needing higher price environments to support tier 2, tier 3 assets or technological developments. I mean, as we look at that opportunity set, obviously you've spoken about the resources you have to go after those opportunities. Sort of how do you view that landscape and build that pipeline in the context of, I guess, that commentary which I've just outlined? Yeah,
I mean, look, right now, I'd say, among the, sell-side advisors that bring oil and gas opportunities to market, there's probably never been, I've never seen deals come as fast and furious as they are right now. And they're coming in all shapes and all sizes. We're kind of prioritizing deals and what I'd say, kind of minimum $500 million and up, given our access to capital with Carlyle. And, when we look at that, it's it is kind of the old, if it has undeveloped acreage, it is kind of the old tier 2 is now tier 1. And that's true whether you're looking in Appalachia, in Oklahoma, or in the Permian. These are, assets that when you look at them, they may have 10 years of what you would have called tier 2 inventory, 5-6 years ago. But when you look at the economics now, it kind of particularly on the gas side, again, even on the oil side, if you kind of imagine more of a $70, $75 world, I mean, these are undeveloped locations that work really, really well. And so it is both maturing, but you're also seeing the undeveloped acreage kind of, get more, in the money, so to speak, than it was a couple of years ago. So we're really excited about the opportunity set. It is PDP-heavy, which plays to our strengths. It comes with some undeveloped, which also plays to our strengths. We've got great ways to strategically optimize, whether we sell down, whether we want to develop something ourselves, or whether we want to sell out entirely. And so we kind of think that Diversified really is positioned, as far as a growth story right now, kind of the right company at the right time, and love the opportunity set. Big pipeline. I'd say we're looking, we've probably got, half a dozen $1 billion plus deals in the pipeline right now, again, across all of our kind of core areas that we're looking. We all, I just did our investor day. We will look at, big Bakken or big Eagle Ford deals. So, places where, capital of scale can really make a difference. We'll look at new basin entries and then look to harvest and realize value just like we've done in all of our other regions. And so, could we do a Bakken deal or a Eagle Ford deal? Absolutely. We're also really still very focused on our core operating areas as well.
Okay, no, that's super helpful. Thank you. And there's a ton more we could dive into, but I'm mindful of time, so we'll sort of keep it to 2 or 3 more. Obviously, you've got a new transaction that you're able to announce and share a bit more about. Can you tell us a bit about that deal? At a high level, what makes it exciting for you in the context of today's market, and what does that transaction say about where we are in the cycle, valuation structure, or competition?
For sure. So this will come out obviously after we announce the deal. But I'm still going to be a little protective in what I say about it, because don't count your chickens until they hatch, as they say over here. And so we're about I'd say 36 hours away from announcing a pretty transformative transaction. I think the highlights, it's in one of our core operating areas. It will come with undeveloped inventory that is going to really allow us to kind of strategically make some decisions around drilling it ourselves, selling down some of it, partnering on some of it. And it's going to give us a little bit of that built-in reinvestment that I think we've really liked from the Mewburn JV that we've got in the Cherokee, as well as it's a way that we're going to really illustrate the power of this Carlyle partnership that we've got. They're buying a majority interest in the equity of the SPV that's going to own the PDP, and then we'll be buying a substantial interest off of it, and that will help fund the organic development that we have going forward on that asset. And so we feel really good. It's a deal that we actually were looking at, and we're kind of basically there on value before prices shot up. And it's one where I've alluded to this in a few investor meetings that that I've attended. We do really good at sort of hanging around the hoop on deals. And we're not always the highest bid or the bid that's going to win, but we're the most commercial. And so we like being, oftentimes number two. And then when a deal falls apart, comes back to us. This is one where we were really patient. And I think the seller's happy. We're very happy. There's just a lot of stuff in there that we feel like we're getting. And it's just going to really transform our platform in one of our core operating areas. So stay tuned. That should be coming out here shortly.
Sounds awesome. Look forward to hearing more about it. And I guess just one, I always try and throw in, I don't know if this is a controversial question, but some more, I guess, curveballs along the way. What is one widely held assumption about upstream investing today that you think investors will look back on in 5 years and realize that they got wrong?
You know what I think the corner is, and it's not their fault. I think upstream investors went 10, 15 years without really making money. I mean, if you look at kind of low gasoline prices, low natural gas prices, consumers really benefited because oil and gas companies were ramping up and didn't really understand the economics of their wells. And so you had this 10 or 15 year span where really the whole global economy benefited from kind of investors that lost their shirts in investing in shale. And I think that, when they look back in the past, they say, oh man, we didn't make any money in oil and gas. I think if you look at the next, 10 to 15 years, people are going to really wish they'd gotten in, right now, because look, even if oil prices come down, I do think this structurally, resets the floor on oil to a degree. And then, and there's a big case to be made that as we move into tier 2 acreage, if we are still balancing the market, that we're going to need higher oil prices to do that. And so I think what, the past is not, prologue, and people are going to look back and say, I stayed away from this sector because, my fund or, funds like me weren't making money in this sector, from 2014 to, 2024. And if you look at it now, I think 2026 to 2036 could be a really exciting time. And so I think that's one of the most misunderstood things, is that just because it didn't work back then doesn't mean it can't work now.
Okay. Well, look forward to sitting down again in 2036.
There we go. Yeah,
seeing how that plays.
We'll look the same too.
2 quick fire questions just to finish up. ABS and energy, early innings or maturing market?
I think could be early innings still. It's when you look at the size of some of these other sectors where you see ABS money, they're much larger than oil and gas. So I do think that this could get to continue to grow in size in terms of the number of ABS financings, the number of companies that use ABS to finance. But that also goes along with, you still need the equity capital. So you need a greater return of equity investors who kind of believe in the ABS model. We're totally fine with it not blowing up. We love the ABS product and we'll continue to use it. And so if we don't see a lot of rush of capital, we're okay with that because we're doing really well with it. Where we are right now. But I do think you could see it being early innings and seeing much more of the market get securitized. You've got some big players like Carlyle who have large ambitions to put a lot of money to work. And if you get a few of these other groups that think the same way, you could see a lot of money come into the sector. But right now, I think it very well could be early innings in it.
In one word, buyer or seller's market?
Gas, buyers, oil, sellers.
Okay. And finally, biggest risk investors are underpricing right now?
That's a great question. I would say, if you believe in these higher commodity prices, I think thinking through what that means on the service costs, and that could be anything from, compression costs to, drilling costs, your frac costs. I think, when we run a lot of our models, we say, hey, we're kind of anticipating, if you saw this kind of strip, X%, potential uplift in service costs. But, if this really hangs in there for a while, you could see something more robust in terms of service cost inflation. So I think that would be the one where, whether it's on the LOE side or the capital side, you'd really want to pay a lot of attention to.
Okay. Well, Michael, really appreciated the time, enjoyed the conversation, and look forward to
absolutely
delving into this in more detail at the New York event and NASDAQ next month. So great to catch up. Thanks, Michael.
Absolutely.